Welcome back to Investment 360. Joining us now from Cape Town, Khulekani Dlamini from Afena Capital. Khulekani, it's always a pleasure having you on the show, and you're looking very calm and relaxed down there in Cape Town. Let's start with your thoughts on the market. Of course, we hit, as we were discussing earlier, a new record on the JSE All Share today, and I'm going to put the same question I put to you, my guests, earlier. Is this momentum sustainable? Can we kick higher from these levels, or is this, to use Sid Vianello's words, just a flash in the pan?
The difficulty, obviously, is trying to figure out what the earnings are going to do. At this point, I think the market has kind of taken the view that, forgetting the January effect, that possibly there's going to be a reasonable earnings growth. I mean, I've seen numbers that have come out with guys forecasting for the year somewhere between 13 to 15% earnings growth. Now, in that environment, your rating expansion or re-rating of the market as a whole would not necessarily have to be very, very large for the market to actually push up a little bit from these kinds of levels. But obviously, if we do have earnings growth pulling back, it's likely that the market will pull back as well. So I know it's a non-answer, but it really is a function of earnings.
You sound like an economist. What can I say? A non-answer that I would expect from an economist.
Exactly.
Vickers is wanting to jump in here. Maybe he can push you.
Sure.
Khulekani, I mean, I guess the question in my mind is, what's in your portfolio? I mean, are you backing the market to be strong, or are you defensively positioned?
In the portfolios where we have discretion, obviously, to choose between other asset classes, we are quite cautious, meaning we are somewhere between 50% and lower in terms of our exposure to equities. Where we don't have discretion, we still are trying to prefer companies where you have defensive quality. So, your earnings volatility is quite low, your PE ratings are quite reasonable. Now, to be honest, those are few and far in between. So what we are doing is holding on to the things like the bats that one would have had 12, 18 months ago, where, at the time they were quite defensive. The Steinhoffs that we think have reasonably low ratings that don't actually expect the earnings to grow as substantially as one would if the ratings were a bit higher. So we are holding on to defensives at this point. We're not really shuffling a lot into new industrial businesses. We are also offloading gold a little bit. We had a very, very high exposure in gold. We are now diversifying a little bit more into some of the diversifieds.
Are you talking, when you say high exposure,
idea.
Khulekani, when you say a high exposure on gold, are you talking about a high exposure to the gold stocks or to the yellow metal through the new gold offering?
To the actual stocks. I mean, some time back, I'd probably venture about maybe 6 to 9 months ago, the disconnect between the equities and the commodity was quite marked. And we took a very substantial positioning on an active basis in gold. And, obviously at the expense of things like Billiton and Anglos. Now, what we're seeing at current levels is the gold prices, the gold counters have run quite substantially. And if you do comparative charts relative to the diversifieds, they actually have outperformed quite substantially. So it may be time, or it is time for us to
take your money and run
between the golds into diversifieds.
And can I ask you the question about financials? Financials haven't been the flavor of the month or the year for a while. How heavy or low are you on financials?
I'll separate the two. So you'll start with insurers. We were quite heavy in insurers. We have a great love affair with Old Mutual and Discovery. And we were actually we had quite a substantial active
You must be
positioning
smiling on Old
two.
Mutual's share price
Banks,
performance.
Oh, that obviously had been a bit of something that makes the heart shine.
We call it value
which,
unlock,
for
Mr.
more of
Dlamini.
Yes, a heck of a lot of luck. But to be honest, on Old Mutual, the idea was quite clear. It was trading at the time on 0.6 EV, and its peers were sitting somewhere between 0.9 to 1. And the idea was that the re-rating would actually come through, and it would come through as a function of specific catalysts. And some of those catalysts did come through, and some of the ones we didn't actually count on came through as well. But anyway, so
wait, before you go
Yes.
on Old Mutual, I didn't say it was luck. I said it was value unlock.
Oh,
luck.
okay.
You were doing
And
the right
luck
thing.
as well. And then on the banks, we obviously have chosen a few banks that we think are quite cheap and have reasonably good earnings prospects, but really we've largely been quite neutral banks. Now, if you look at where they currently are sitting, some of them are sitting at, well, actually not some of them, all of them are sitting within 9 to 11 times earnings, Standard Bank being sitting at the 11 times level, but with quite reasonable dividend yields. And in terms of earnings prospects, you know, they've actually not done anything from an earnings point of view. If anything, they've disappointed. You know, you haven't seen top line growth, you have seen your bad debts come back, but obviously the catalyst that one would have wanted would be sort of collinearity, the bad debts and the top line growing simultaneously, or bad debts pulling back and the top line growing simultaneously. We didn't see that. So we've had a very muted earnings growth from the banking sector altogether. So we basically are now starting to find attractive value in there. Things like Investec for us are really quite interesting. Yeah.
All right, and we have to
Investec is
touch
actually
again.
quite
I'm
an
sorry, we're just
interesting
running out of
idea for us.
time. We're running out of time this evening, and I can't catch myself. So we need to chat about MTN, because I know you're a big advocate of MTN. Well, you look at the stock particularly, and it has been under pressure of late. We mentioned the risk that it faces in Iran earlier today. What are your thoughts on that front? And we're going to have to close out on that one, Khulekani.
Okay, Iran is small. Iran in their lives is 8% of EBITDA, less actually. The question or the issue really is what other shareholders, especially the ones in the US and possibly in the EU, should the EU in 6 months' time decide to enact the embargo on them, you know, what those people are going to do with their shares actually has a bearing currently. If they're heavily exposed to MTN, then they may actually be forced to sell. So it's not necessarily an earnings issue. It's more of what shareholder behavior is going to be as a function of them being forced to
So
sell.
at 135 Rand, very quickly, what is your stance going forward on MTN?
I'm still quite a bull on MTN. I think the upside growth that we're going to see is it's amazing, and we are sitting on almost 10 times the forward earnings to 2012 for a company that may possibly give out 70 to 80% of its earnings and dividends. You know, we should have a re-rating when they start doing that. So I'm quite happy. Cash generation is good. Margins are robust. They're a little bit high, but we factored in that they may come back to reasonable levels, and the cash generation will continue to be there, and the dividends will continue to flow.
As I said earlier, always a pleasure having you on the show. Thank you very much for your insights. Khulekani Dlamini from Afena Capital in Cape Town.